Hey, my name is Mo Rahim, and this is Mary Jane Markets. Today we're going to be taking a look at 2021 second quarter earnings for Cresco Labs, Curaleaf, Green Thumb Industries, and Trulieve. First of all, I want to apologize for not posting anything in a while. It's been a few weeks since the last episode, and I've been bogged down with my day job, plus two of my really close cousins are getting married. Going this long without providing any updates goes against the purpose of this podcast, which is to keep you updated with the news of the North American cannabis sector, and specifically those companies I mentioned. More apologizing to be done later, but first let's take a look at how the market has fared this month. Most of us went into this month optimistic. We had the tailwind of a national discussion with the Cannabis Administration and Opportunity Act, and we were looking forward to earning. But August has turned out to be a really red month for the sector and for the companies I cover. With just a few days left in the month, it seems most likely that we'll close out August lower than we started it. I've mentioned before that volatility in this sector is not uncommon. There are more variables that impact share prices in this sector than some other sectors. These companies can post great earnings, report amazing growth, but there is more to it than just the supply and demand equation that is our companies selling to consumers. There are also things like the changing expectations of whether a bill will pass or not that can impact prices, especially in the short term. I don't know definitively why August is going to close out lower. I don't trade equities day to day, and past a certain point, I don't try and understand short-term price movements. I'm a buy and hold long-term investor, and I have conviction that in the long term, this sector is going to be really big. I have conviction that these companies will continue to grow and be more profitable, and I have conviction that there's a lot of consumer demand out there. And I'm not concerned about short-term price movements, and I think if you have those same convictions, you shouldn't be either. All right, so first up is Cresco Labs, a hometown favorite here in Chicago. They reported earnings on August 13th. For their top line, they reported revenues of $210 million, which was an increase of almost 123% year over year. I really like to look at year over year numbers rather than quarterly growth, but that's just me. Maybe it takes out the seasonality effect of the quarters a little bit, but I am just biased to long-term thinking. And they're reporting gross profit here of 51%. That's excluding the fair value markup, which is what we want to look at. That's a respectable number at 51%. It's not industry leading or anything like that. I think Trulieve still holds the crown there, but it's about on par with its peers. I actually expect gross profit for Cresco to be a little lower than its peers, just because they focus more on the wholesale side. They do have retail stores. They're just really strong with their wholesalers, or wholesaling rather. They even describe themselves up here as the #1 US wholesaler of branded cannabis products. They break out their revenue here, saying record net wholesale revenue of almost 109 million. That's coming from wholesale. And then their retail revenue of 101.3 million from 33 stores, and that grew at 158% year over year. And this actually grew more than their wholesale revenue, and probably most likely next quarter it'll surpass their wholesale revenue. Adjusted Ebitda of 45.5 million. I'm not a big fan of Ebitda or the games companies play with adjusted Ebitda, but totally okay here since they're excluding fair value markup, which is just something that GAAP and IFRS accounting requires them to include in their income statement. And then finally, a net income here of 2.7 million, which is an increase of 26.8 million quarter over quarter and 44.4 million year over year. And I think they're just highlighting their efforts to become profitable on the bottom line. That's something they've received criticism on over the last couple of years. Moving along, we'll come back to guidance in a little bit. We'll also take a look at the balance sheet that's provided at the end of this release. Of course, the big acquisition they made of Bluma Wellness is in here. That was their entrance into the Florida market for 16 billion shares. So we should see that reflected in the balance sheet below, even the statement of cash flows, I guess. Okay, so here is the consolidated income statement. Leftmost column here is for this current quarter, ended June 30th, 2021. And most of my comparisons I'll be doing against the prior year's Q2, June 30th, 2020. So as we can see here, huge growth in revenue going from about 94 million the year prior to almost 210 million. COGS, of course, went up. Their gross profit, though, along this line, went up all the way from 33.7% to 48.1%. That's telling me that they're becoming more efficient in their operations. Of course, as their operations are growing, you'd expect things like SG&A cost, share-based compensation, depreciation, and amortization to be growing year over year, quarter over quarter. That's all totally normal. And then instead of a loss of nearly 21 million just a year ago, the company's become profitable in its operations. That is down slightly from last quarter, and most of that's attributed to just eyeballing it here, SG&A, which in their actual filing, they report most of this coming from payroll and employee costs and selling and marketing expenses. Jumping down to their super consolidated balance sheet here, I don't like this at all. Kind of raises more questions than it answers, and I have a really strong impulse to go over all of those questions with you, but for the sake of time, I'll sort of just summarize this and hopefully do a earnings preview episode going into, let's say, Q3 earnings for just Cresco. But taking a look at their tiny balance sheet here, left column here is for end of Q2, and the right column here is, you can think of beginning of the year, ended December 31st, 2020. So cash on hand, cash or cash equivalents down slightly, down $5 million. Not a concern. Other current assets are up almost $50 million to $162 million from $113 million. That could be things like short-term treasuries or other highly liquid investments. Of course, in here, they don't break down how much of this is restricted cash. But moving along to property and equipment, it's gone up about $70 million. Most of that, I'm sure, coming from the Bluma Wellness acquisition, and their intangible assets and goodwill have gone up substantially here. I'm sure most of that is also coming from their Bluma Wellness acquisition. Overall, their total assets have increased by around $350 million in the last 6 months. On the liabilities side, their current liabilities have gone down about $60 million, down to $195 million. Their long-term liabilities have gone up about $70 million. You'll notice that their current liabilities are greater than their cash on hand, but they still have a business that's throwing off money. They also have these other current assets they can sell, so not concerned on that front. Here is their consolidated statement of cash flows if you're interested. If you're actually interested, just go check out the SEDAR filing. This is almost useless. I do want to jump back up to the provided guidance for the rest of the year. I'm using this to update my 2021 outlook, and they mentioned 3 things here. 1, annualized revenue run rate of $1 billion by the end of 2021, gross profit margins in excess of 50% in the remaining 2 quarters of 2021, and 3, adjusted Ebitda margin run rate of at least 30% by end of 2021. Overall, it's hard not to be happy with 123% year-over-year growth. I'll be even happier if they do achieve this 1 billion run rate by the end of 2021. And if their retail revenue here starts to meaningfully exceed their wholesale revenue, the margins on the retail side are just much better. And I expect they will with the Bluma Wellness acquisition in Florida. Bluma has to be vertically integrated, so they own their own stores. What would make me even happier is if they started to include a lot more detail in these earnings releases. At least these press releases, I should say. The full details you can find on SEDAR's website here. Be sure to check out the MD&A, that's the management's discussion, as well as the interim financial statements and report. Let's move on to Curaleaf though. I'll try and move through this a little bit faster. We're 13 minutes into this and only covered 1 company so far. Curaleaf reported earnings on August 9th. Their headline metrics here were that revenue was $312 million, which was up 166% year over year, or 20% sequentially. They had an adjusted Ebitda margin of 28% on their US operations, which was $84 million. And they closed the acquisition of EMAC, Europe's largest vertically integrated cannabis company, which will be renamed Curaleaf International. All right, so going through this release, here is some super high-level financial highlights. Just trying to get all of this on one screen for you guys. So, like I mentioned, total revenue up from $117 million in Q2 of last year to $312 million. Gross margin increased from 42.9% to 49.6%. They did report a net loss of just over $7 million. I'm going to skip down to their revenue breakdown here. Most of their revenue coming from their retail side. So of that $312 million, $222 million came from their retail and $89 million came from wholesale. They also had a negligible amount coming from management fee income. I expect that to remain low going forward. I'm going to jump down to their consolidated income statement here. See if anything jumps out at me. So of course, revenue is increasing, operating expenses are increasing. Slightly different GAAP number being reported here for their net loss, about a $2 million difference. And of course, the big thing that jumps out at me is their share dilution. at 701 million shares outstanding. That's almost up 170 million from last year. Again, I apologize for not being able to provide a whole lot of context around these numbers and rushing through all this in one episode. I want to go back up to the balance sheet here. Quick glance at the balance sheet now. Their cash position has increased greatly here, almost a $250 million increase from the beginning of the year, if I'm doing my quick math right there. We'll see where that comes from down on the liabilities side. PP&E, property, plant, and equipment, has increased. They did mention they were going to invest about $41 million in that this quarter. So that about lines up. Their intangible assets and goodwill here increasing by a lot. You'd expect that, as we saw with the Cresco Labs. You'd expect that with any company that's doing a lot of M&A. Going down to the liabilities and shareholders' equity side of the balance sheet. Not a whole lot of differences on the current liabilities side. Their long-term debt, notes payable, has increased about 150 million, eyeballing that. So looks like that's where a lot of the cash came from. Lease liabilities increased a little bit. Some other liabilities from the merger, I expect. And if they raised 150 million in debt, I expect the rest came from shares. Right, really atrocious summary there. Apologize again for not providing much insight into these numbers. And it's about all I saw on the Curaleaf press release. Again, if you're a serious investor, you should seriously look at those SEDAR filings, listen to the earnings calls, rip apart these financial statements line by line. Don't just settle for my summary here. But we'll move on to Green Thumb Industries. They reported earnings on August 11th. They're highlighting an 85% year-over-year revenue growth to $221 million. Another positive GAAP net income quarter, delivering $22.1 million in net income. Adjusted Ebitda of 35.7%, growing 11.1% sequentially to $79.3 million. They also raised $216 million in senior debt at 7% interest, absurd, and retired some $105 million in debt at an even more absurd 12% there. And at the beginning of June, they acquired Liberty Compassion in Massachusetts. Skipping down to their income statement here. Comparing again to last year, Q2 2020, their revenue grew from 119 million to 222 million or thereabouts. The gross profit increased almost 100% as well to 123 million from 63 million. I'm not concerned at all with these companies reporting slight hits to gross profit or gross profit margins, especially when they're growing like this at 100% year over year. And they don't provide much information at all after that. They report SG&A and then drop down to other non-operating expenses and report net income here of 23 million. Another thing that jumps out at me is their shares outstanding. So their share count here up to 224, around 225 million fully diluted from 200 and almost 210 million a year ago. So this company is not diluting or hasn't diluted as much as the other two we looked at. On the surface, that's a very good thing for existing shareholders. Of course, with young, high-growth companies, you want them to be able to, or to be raising capital and reinvesting that profitably into growth. So far with Cresco, we've seen growth through a lot of share dilution with Curaleaf, we saw them raise 150 million in debt. And it seems with GTI, they're preferring debt over diluting shares or selling more shares to raise that cash. All right, moving on to the consolidated balance sheet down here. Comparable cash and cash equivalents to Curaleaf and a little bit more than Cresco Labs here at 359 million. Looks like they don't include a comparison to last year. Another reason to check out those SADAR filings. And this is what I was trying to say earlier, looking at these income statements and balance sheet over, a period of time, years, can tell you a story about the company. A lot more than just a snapshot and point in time of one quarter. Anyway, moving on, total current liabilities here of 105 million, which they'll be able to easily cover with their cash on hand. Net of the current portion, their net debt is 197 million, and lease liabilities, which is basically just another kind of debt, is 165 million. Other long-term liabilities are another 96 million. I'll do a GTI specific episode once I've consolidated all this and cleaned up my spreadsheets like I was saying. I'll do that before Q3 earnings. Let's move on though to Trulieve. Trulieve on August 12th, reporting earnings. Let's take a look at their highlights. I scroll down a bit. So, achieved revenues of 215 million with a gross profit margin of 67%. They got to be the industry leader on this. I've seen that as high as 70% sometimes for them. So, gross profit of 144.5 million on revenues of 215 million, which is just amazing. Adjusted Ebitda of $95 million and net income of $50 million. Truly, for those of you that don't know, took a very different strategy as it grew. Very different compared to, the three that we've looked at, Cresco, Curaleaf, and GTI, that were very much focused on expanding into new states early. Trulieve focused on becoming a powerhouse in Florida. So that's definitely why their gross margins are so high, why they're so profitable. I think right here in the summary, they say they're reporting their 14th consecutive quarter of profitability. So they've had not a smaller business, but a simpler business, just operating mainly in the one state. Of course, critics have held this against them, saying that their future growth potential isn't as high as some of these other MSOs, but they've started to expand into other states as we've talked about, and as you can see here, one of their highlights here being that they announced plans to acquire Harvest Health. I think we've touched upon that $2 billion acquisition in a prior episode, but they just still dominate in Florida, as is evident in the OMMU weekly sales reports that come out of the state. They also mention here they opened their 91st store in the nation, 85th dispensary in Florida, and this press release was from August 12th. I think they recently opened their 100th store. So they execute really well in Florida. Anyway, getting back to financials, at least what they provide in this earnings release. A little bit confusing of a table. This first block here on the left is for this quarter and last quarter of 2021. So Q2 and Q1. This second block is a year-over-year comparison, so comparing Q2 2021 to Q2 2020. And then this third block is for 6 months, comparing the first 6 months of the year 2021 versus 2020. So I'll focus mostly on this middle column, which compares Q2 this year against Q2 last year. Revenue growth here, top line, increasing 78% from 120 million to 215 million. Gross profit of $144 million this quarter, which was a 60% change over last year. Gross profit falling a little bit to 67% from 75%. I think this is to be expected as they expand into different states, much different than the low 50% range we were seeing with our other companies. And not to go too far down this tangent, but I kind of view Trulieve as what companies can be when they've reached maturity or when they've stopped scaling out or reach a steady state. And it's another reason why I wanted to cover Trulieve on this show. And it's really fun for me to dive into these numbers, more so than what I'm doing here, just looking at high level stuff. But moving on, operating expenses about in line with what we've seen in the past at 29%. Obviously, as the company grows, operating expenses are going to grow, and posting a monster net income profit of almost 41 million, 116% growth year over year. Other than that, Trulieve does not have a whole lot of interesting information here in this press release. All right, I do apologize at how rough and high level that was. And I'm just now realizing that maybe I didn't have my mic set when I was last showing this slideshow. Anyway, thanks for sticking with me if you're still here. I have to get through these production issues and these growing pains. If my mic wasn't on in the last slideshow, I basically said that my own valuation spreadsheets were just a total mess and I didn't feel comfortable sharing that out or presenting it because it wouldn't have been very clear. So we just went over the earnings press releases today, and that ideally I'd spend an entire episode on just one of these, diving into the actual filings rather than just the press releases. But I've dug myself into quite a bit of a hole here, so I feel like I at least had to address earnings before moving on to the normal programming. So getting this out of the way, there's probably going to be at least one more catch-up episode. I already have that planned. I just need to record it. And I think that's going to be all for today. If you want to contact me, my Twitter handle is @MJMarkets. Thank you so much for listening. And I promise it can only get better from here. Thank you.